Good morning and welcome to 3 Minutes on Markets and Money. After the markets ratcheted an all-time high on Tuesday, markets did sell off yesterday on news that, well, the Federal Reserve is not quite ready to jump back in with a whole lot more quantitative easing and more monetary support. In fact, they warned about more risk in the economy as stocks continue to levitate here, really kind of in defiance of the fact that the economy is still in a recession. And while stocks may not seem to be the economy, just remember that the economy is what drives earnings and revenue for the stock market, those companies in the markets. Another thing today is also noted is that while the market has now reached all-time highs, only 6% of companies in the index have actually reached a 52-week high. Now that is much, much lower than the 40 to 50% that were hitting 52-week highs back in February, the last time we were at all-time highs. Okay, here's the important thing to cover this morning is that we now have a money flow sell signal on the markets here in particular. So this is the S&P 500 index proper, and we have now triggered a money flow sell signal. Now, this doesn't mean the markets are about to crash, but what it does suggest is that historically when you have these money flow sell signals, markets tend to be sloppy, at least for a small period of time. And this has happened repeatedly, kind of going back. We get into these kind of consolidation phases, kind of in an upward trending market, but these money flow sell signals can also correspond with bigger declines in the market. So it's not necessarily worth completely dismissing entirely, just saying, oh, well, it's money flow sell signal short term, and it just means markets are going to kind of consolidate here. It can lead to a bigger decline in the markets. And after such a long advance here in the markets, it is important to understand that markets can have a 5 to 10% correction, completely normal with any given year, and that would feel much worse than it is currently. So pay attention to this risk. The other risks that are currently in the markets as well is that markets are back to very, very overbought conditions on a short-term basis as well as on a longer-term basis as well. These overbought conditions also typically correspond with market tops and at least short-term corrections. Now, pre-election, September and October's of election years tend to be weaker months of the year, and you typically have negative periods of returns prior to elections in September and October. And of course, with all of everything that's going on with the economy, that certainly wouldn't be a surprise. And if we kick out here to our longer term chart, now this is a weekly chart of the S&P 500 going back over time. You'll also notice that we are now very close to a money flow sell signal on a weekly basis as well. Now, the weekly signals are much more important to pay attention to. Now, we're not there just yet, and it'll only take a little bit more of a correction in the markets to trigger this. But going back over time, you see that money flow sell signals at the weekly basis tend to correspond with short-term and bigger-term peaks in markets. So again, this is something much more important to pay attention to and suggests that maybe right now is a good time to start thinking about reallocating portfolios, reducing risk here just a bit, and maybe think about adding some non-corollary investments, bonds, etc., that could hedge risk in your portfolio short-term. I'm your host, Lance Roberts, for 3 Minutes on Markets and Money. We'll see you next week.